Right now, a threat actor known as Shiny Hunters holds the digital records of approximately 275 million students, teachers, and staff. They gained entry through a single vendor that controls the infrastructure for thousands of school districts, setting a firm deadline of May 12th to release the exfiltrated data if a ransom is not paid. If you consult the official channels, the platform's communications, and the advisories distributed by individual universities, the crisis is over. Authorities are officially framing the event as a contained anomaly, resolved through routine security patches. That printed assurance contradicts the physical reality on the ground. 30 million active users are facing a completely different environment. Students are locked out of their logins, university finals are scrambled, and users are greeted by hijacked screens displaying ransom demands directly from the threat actors. Because the institutional narrative is severed from the operational reality, a separate, predictive surveillance mechanism in the capital markets has taken over. A specific contract tracking the probability of a confirmed breach is currently trading at 0.68, pricing the true risk far above the official estimates. You are standing at a fork. The situation you are watching unfold is being fed by how you choose to look at it. If you are still waiting for an official confirmation of danger, you have not yet decided to stop looking to institutional authority for your own safety. The philosopher Emmett Fox proposed a specific mechanical lens for moments like this. You cannot fight the trouble. You can only change the mind that perceives the trouble. The institutional memo of containment is an illusion. Your continued reliance on that narrative, rather than the raw data of the market, is the primary source of your exposure. To understand why the official narrative fails, we have to look at the operational concentration of the system itself. 41% of North American higher education learning infrastructure relies on a single vendor, Canvas. In November 2024, the investment firms KKR and Dragoneer executed a $4.8 billion all-cash transaction to buy Canvas's parent company, Instructure. That transaction took the platform entirely private. The exact legal consequence of that buyout is a structural blackout. Public companies are bound by the SEC's Item 1.05 of Form 8K, which forces them to disclose material cybersecurity incidents within 4 days. Private ownership entirely removes the legal requirement for that public disclosure. This creates what is known as the SEC shadow, a regulatory blind spot where the public disclosure regime, originally built to protect the public, no longer functions for the digital infrastructure holding our most sensitive records. That structural drift is reinforced at the agency level. Under Chairman Paul Atkins, the SEC has explicitly shifted toward a principles-based enforcement posture, narrowing the practical application of the disclosure rules that remain. The agency's voluntary dismissal of its landmark disclosure case against SolarWinds proves the shift. The regulatory law surrounding cyber disclosure is now functioning as a tunable variable subject to administrative triage, not a hard boundary. Apply the Fox lens here. The definitive authority you seek regarding the safety of your data is absent. It is absent because the ownership structure was intentionally redesigned to evade that exact authority. For privately held digital platforms operating at massive scale, the public 8K disclosure machinery is effectively dead. That death creates a dangerous information asymmetry between the platform owners and the user base. That information asymmetry compounds a second structural crisis, velocity asymmetry. AI-accelerated exploits now operate at machine speed, identifying vulnerabilities and crashing through network defenses in fractions of a second. Human institutions cannot match this pace. School districts and universities operate on 5 to 7 year procurement cycles, academic calendars, and slow governance reviews. The International Monetary Fund recognizes this as a systemic threat. Managing Director Kristalina Georgieva frames the AI cyber threat as a financial stability crisis, specifically citing frontier models capable of finding vulnerabilities in every major operating system, even when used by non-experts. Bank of England Governor Andrew Bailey issued a parallel warning. Frontier AI systems possess the capacity to crack the whole cyber risk world open. The gap between machine speed attacks and academic year responses operates as a furnace. Risk compounds exponentially while institutions schedule meetings to address breaches that have already concluded. This creates a self-reinforcing loop. Because the infrastructure remains online, every user login and uploaded assignment during a breach week flows directly back into the same compromised platform, providing fresh data for the next iteration of the exploit. These human institutional cycles are structurally incapable of defending against the current velocity of exploitation. Because public company disclosure triggers are gone and institutional speed is irrelevant, the capital markets have emerged as the only viable, active surveillance instrument for digital breaches. This graphic isolates the reality gap. Capital markets are pricing the probability of a massive data leak at 0.68. The official company narrative of containment implies a probability of only 0.55. That leaves a plus 0.13 pricing discrepancy between market truth and narrative illusion. Look at how the CyberEd contract at 0.68 behaves against other institutional risk signals. It operates entirely independent of the European Google compliance contract at 0.42 and the June CPI inflation contract at 0.58. Capital allocators are ignoring the advisory memos. They are pricing a physical hole in the platform's foundation, and they are locking their positions to the May 12th ransom deadline established by shiny hunters. The market sees the regulatory environment clearly. In the US, the law is an adjustable variable. By contrast, European executives like Henna Virkkunen enforce a strict law-as-boundary posture, utilizing fines of up to 20% of global turnover for platform non-compliance. The core fact the market recognizes is that the North American educational technology system is not broken. It is optimized exactly as designed, for cost-minimized single-vendor procurement. You achieve that integration and unit cost compression by sacrificing operational resilience. The continuous broadcasting of containment language is a psychological stabilizer for the platform's procurement reputation. It is not a technical description of the network's integrity. The reality gap is simply the space where institutional authority goes to hide from the market's priceal of truth. Apply the Fox substitution. You cannot compel a private equity firm to pay a ransom demand. You cannot rewrite the SEC's enforcement triage to force a public disclosure. If you are waiting for the institutional authority to validate the breach and tell you your data is compromised, you are actively participating in the information asymmetry they designed. The 0.68 market price is the active, functioning surveillance instrument. The containment advisory resting on the desk is the illusion. As Emmett Fox observed, you cannot fight the trouble. You can only change the mind that perceives the trouble. Your internal agency, your conscious decision to discard the official narrative and read the market data, is the only thing that can bridge the reality gap. The May 12th deadline is imminent. The trajectory will fork. Either the threat actors execute a massive data leak that validates the 0.68 price, or the platform owners negotiate a private settlement and the contract collapses. Exercise your agency right now. Sever your reliance on the institutional language of contained vessels. Read the capital signal. De-link your own positioning from the expectation of external rescue. Read the signal. Trust the